The end of the Cold War. These were, really seismic events that won't be replicated in the future.
Okay, John, first of all, how then would you address the idea that a slowdown in trade growth correlates to global integration?
Well, it's a good question. I mean, basically, the last 5 years have seen trade growth of less than 3% a year, hovering around 3% a year and matching global GDP growth. And that contrasts to the period before the 2008 financial crisis, where for at least a decade and a half, trade growth was double GDP growth. I mean, 6-7% a year compared to 3% a year right now. And when trade is growing faster than the world economy, that is a clear indication of integration, of economies growing more interconnected or interlinked. When it's stable like this, you can infer that integration has stopped. At least it's at a steady state level, if not going backwards. At least that's what the numbers indicate.
So if integration stopped, then are there any significant structural factors that are leading towards, well, I suppose, disintegration globally?
There's a couple of theories. I mean, one is it's just a pause, that this is the sort of natural aftermath of the global financial crisis and the Great Recession, and that after this period of stalled integration or apparent stalled integration, the engine will start up again and we'll start interlinking and we'll go back on the growth path we saw before the 2008 crisis. There's other theories though. Some people say that, for example, the spread of network production, what we call global value chains, where companies break up the distribution and production system and disperse it around the planet where there's the lowest labor costs or the most technology, that some people would claim has stalled and in fact gone back. There's been a kind of if the word of the 1990s was offshoring and outsourcing, there's kind of a reshoring going on where companies are bringing production back. And maybe that's related to informatics and the onward progression of robotics, where there's less and less of an advantage in going to, for example, low labor cost jurisdictions. That would be one theory. There's also the sense that maybe the big bangs of integration have already happened. I mean, bear in mind that the numbers we saw before the financial crisis, this 7%, 6% trade growth a year, reflected huge geopolitical changes in the world. I mean, Cold War comes to an end at the end of the 1980s. The Soviet Union breaks up and its various pieces try to join the world economy. The biggest story, of course, was China. It goes from a very closed, inward-looking economy to an increasingly outward-looking economy. There's only one China. There's not another China waiting in the wings. So those trade figures reflected China's integration. The deeper worry is that we're watching the effects of kind of creeping protectionism, that the kind of enthusiasm we saw for liberalizing trade, liberalizing investment flows, integrating is slowing down, and that governments are imposing a series of small micro protectionist policies that are clogging up the wheels of trade. So those are the theories.
Okay, so plenty of theories like you said, but is there one in particular that you give significant credence to?
Personally, I think we can rate the fear factor. I put a lot of emphasis on seeing trends in a long-term perspective, and although we are going through a period of relatively slow trade growth, I do think we have to see the previous 2 decades as, in a sense, anomalies. I mean, and the ones I explained, the China phenomenon, the end of the Cold War. These were, really seismic events that won't be replicated in the future. We will see other aftershocks. I think what we're seeing, for example, in Africa and in parts of Latin America, where African economies are increasingly trying to integrate amongst themselves and join these globalized production networks I talked about. This could be the next China or the next wave of integration that we're looking for, but it's not the same effect as a closed nation of 1.2 billion people suddenly opening up and integrating.
Okay, and lastly then, how effective are the current tools for measuring globalization, do you think?
Now, Sam, that's a great question, because I think one of the problems in this whole debate is we don't actually measure trade flows as well today as we did, say, 20 or 30 years ago. And that's not because we are trying less hard, it's because the nature of economic activity has changed. I mean, it's relatively easy to, not super easy, but it's relatively easy to chart the flow of autos or auto parts across borders, physical things. It's much less easy to quantify and measure the flow of digital products across borders. I mean, you know, we all get on our mobile phones every day or our computers and do a Google search, and it's a kind of information trade. I mean, you're exchanging a service across global networks. You're sourcing information, but that wouldn't show up anywhere in a trade statistics. That's an invisible, and it has, in a sense, it has value, but it has no monetary value because it's a free service. So there's a lot of things we do every day in the world of digitized trade. You know, e-commerce would be the obvious example, where you order things over Amazon, or you download music over iTunes, or a film off of Netflix. It does have a monetary value. It's a kind of trade, but it's not easily captured in trade statistics. So it could be that the physical trade that we've measured in the past, the bushels of wheat and the tankers of oil and the autos or the washing machines crossing borders, has slowed or stabilized. But the digital trade has surged probably, and we're just not measuring that.
Okay, John, thank you very much for your insight today.
Thanks for having me.
And thank you for watching. Be sure to click back to Dukascopy TV for more updates and exclusive interviews. We'll see you next time.